Alright everyone, so get this. California's housing market, the one that's been defying gravity for decades, is finally doing something nobody thought was possible. It's cracking. For years we've all heard the insane stories. Million-dollar teardowns selling for cash, insane bidding wars over tiny bungalows, and studio apartments priced higher than mansions in other states. It seemed like the only way for prices to go was up, up, and up. But the party might be over, and the hangover is starting to kick in. In some of the state's most iconic cities, home prices aren't just cooling off. They're in an absolute free fall, and the drop is staggering. We're talking about a fundamental shift that could reshape the entire real estate landscape of the Golden State. The days of listing a home and having a dozen offers over asking by the weekend are vanishing in certain areas. Instead, we're seeing price cuts, listings sitting for months, and a level of buyer panic turning into seller despair. This isn't just a minor correction. For some markets, it's a full-blown downturn that's catching homeowners and investors completely off guard. This is the moment many people have been waiting for, and for others, it's the moment they've been dreading. So, listen up, because this is important. If buying property in California has ever crossed your mind, even for a second, what comes next could save you tens of thousands of dollars or help you dodge a financial disaster that could set you back years. We're gonna break down the 10 cities seeing the biggest price drops, why it's happening, and what it means for you. So, do me a quick favor and hit that like button and subscribe to Houseline USA so you don't miss the next warning sign before your equity disappears. Let's get into it. Let's kick things off in the heart of Silicon Valley, San Jose. For as long as anyone can remember, this city has been the epicenter of tech wealth, where stock options turned interns into millionaires overnight and real estate prices were basically a vertical line on a graph. If you wanted to live here, you had to compete with a flood of cash-rich buyers who didn't even blink at seven-figure price tags for starter homes. The entire market was built on the assumption that the tech boom would never end. Well, it looks like we've found the end. The headlines tell the story better than I can. Major tech companies, the very ones that fueled this housing frenzy, are announcing massive layoffs. We're talking tens of thousands of high-paying jobs disappearing, almost in an instant. This isn't just a little trim here and there, it's a fundamental shift in the industry. As a result, the pool of buyers who can afford a $2 million median home price is shrinking, and it's shrinking fast. The confidence that drove people to waive all contingencies and bid $500,000 over asking has evaporated. What happens when the music stops? The inventory starts to pile up. Homes that would have been sold in a weekend are now sitting on the market for weeks, then months. Sellers who thought they had a golden ticket are now facing the harsh reality of price cuts. We're seeing a surge in homes for sale just as the number of qualified buyers is plummeting. It's a classic case of supply and demand flipping on its head, and the numbers are showing the damage. Officially, prices in San Jose have dropped by a staggering 5.5% year over year. Now 5.5% might not sound like an earthquake, but let's put that into perspective. On a typical $1.5 million home, that's an $82,500 loss in equity in just 12 months. For someone who bought at the peak with a low down payment, they could already be underwater. For buyers, this is the first glimmer of hope they've had in years. For sellers, it's a wake-up call that the rules of the game have completely changed. This isn't just a dip, it's a warning shot. The combination of tech layoffs, rising inventory, and the sheer unaffordability that was normalized for so long has created a perfect storm. The question now is whether this is the bottom or just the beginning of a much steeper slide. Buyers are finally gaining some leverage, negotiating prices down and demanding inspections. Sellers are being forced to adjust their expectations, and many are realizing they missed the absolute peak of the market. San Jose is our canary in the coal mine for what happens when a hyperinflated market loses its primary economic driver. Next up, we're heading to the rolling hills and picturesque vineyards of Napa. This is the place people dream of retiring to, a world-renowned destination synonymous with luxury, wine, and a relaxed, upscale lifestyle. For years, the Napa housing market seemed as bulletproof as its reputation. It was a haven for wealthy retirees, second-home buyers, and city dwellers looking for a scenic escape. The demand was always high, and the supply was always limited, creating the perfect recipe for ever-increasing home values. But something has changed in paradise. the post-pandemic landscape isn't being as kind to Napa as many expected. The remote work revolution, which initially sent a wave of buyers flocking from the Bay Area, has started to shift. Companies are calling employees back to the office, and the appeal of a long commute from wine country is fading fast. That, combined with a slowdown in tourism and the broader economic anxieties, has put a serious damper on demand for luxury and vacation properties. The data coming out of Napa is frankly shocking for a market that has been so resilient. An incredible 68% of homes in Napa are now selling for below their original asking price. Let that sink in. More than 2/3 of sellers are not getting what they initially wanted. The days of bidding wars and above-ask offers are a distant memory. Instead, sellers are having to make significant concessions just to get a deal done, and buyers are finally in the driver's seat, able to negotiate from a position of strength they haven't had in over a decade. The result of this power shift is a significant 4.2% drop in median home prices year over year. Again, on a multi-million-dollar Napa estate, a 4.2% drop is not pocket change. We're talking about hundreds of thousands of dollars in lost value for those who bought at the 2022 peak. The dream of buying a vineyard-adjacent property as a can't-lose investment is being seriously tested. The very things that made Napa so exclusive, its distance, its reliance on tourism, and its high-end appeal, are now becoming its biggest vulnerabilities in a changing economy. For potential buyers, this could be a once-in-a-generation opportunity to get into a market that was previously untouchable. For current owners, especially those who leverage themselves to buy their dream home, it's a nerve-wracking time. They're watching their paper wealth decline month after month. Napa's story is a powerful reminder that even the most idyllic and desirable markets are not immune to fundamental economic shifts. The wine country dream isn't dead, but it has become a whole lot more affordable, and for sellers, a whole lot more stressful. Now, let's travel down the coast to San Diego, a city famous for its perfect weather-beautiful beaches and a lifestyle that's hard to beat. For the last decade, San Diego's housing market has been on an absolute tear, attracting everyone from young professionals to retirees. It felt like the demand was infinite. But the party has come to a screeching halt, and San Diego is now posting one of the most staggering price drops in the entire state. The numbers here are not a gentle correction. They are a flashing red warning light. San Diego home prices have plummeted by a massive 6.7% from their peak. On a median home price that was hovering close to $1 million, that's a loss of nearly $70,000 in equity in a very short period. For homeowners who bought recently, that could easily wipe out their entire down payment, and then some. What we're seeing is a perfect storm of high interest rates, sky-high prices that finally hit a breaking point, and a local population that is simply priced out. The affordability crisis here cannot be overstated. The median income in San Diego simply cannot support the median home price, especially with mortgage rates where they are today. Buyers are hitting a wall. They're running the numbers and realizing that even if they could scrape together a down payment, the monthly cost of owning a home would be completely unsustainable. As a result, a huge number of would-be buyers are throwing in the towel and choosing to rent instead, which is causing demand to evaporate from the for-sale market. This isn't just a temporary blip. All indicators suggest a continuing downward trend. Inventory is climbing as homes sit on the market longer, and sellers are being forced to slash their prices to attract the few remaining qualified buyers. We're seeing more and more listings with motivated seller in the description, which is code for please, just make me an offer. The psychological shift is huge. The fear of missing out, or FOMO, that drove the market up has been replaced by a fear of overpaying, or fee up. San Diego's situation is a textbook example of what happens when prices become completely detached from local economic fundamentals. The sunshine tax can only justify so much. Now, the market is being forced into a painful but necessary correction. For anyone who has been dreaming of buying in San Diego but was sidelined by the insane prices, this is the moment to pay close attention. For sellers, it's a brutal reality check that the days of naming your price are over. The balance of power has shifted dramatically in America's finest city. Let's move inland to the state capital, Sacramento. For the last few years, Sacramento was the darling of the California real estate market. It was seen as the affordable alternative to the Bay Area, attracting a flood of remote workers and families who were priced out of the coastal cities. This massive influx of new residents created a housing frenzy, with bidding wars and rapid price appreciation that shocked even the locals. Sacramento was booming, and it seemed like the growth would never stop. But that momentum has hit a brick wall. The flood of people moving to Sacramento has slowed to a trickle, and in some cases, it's even reversing. The Zoomtown boom is fading as more companies mandate a return to the office, making a home in Sacramento impractical for a Bay Area job. At the same time, the city's own affordability has vanished. Prices were pushed so high, so fast, that Sacramento is no longer the bargain it once was. Local wages haven't kept up, and now even residents who have lived there for years are struggling to afford a home. The most telling sign of this shift is the explosion in inventory. The number of homes for sale in the Sacramento area has skyrocketed. We're talking about a market that was starved for listings suddenly being flooded with them. Sellers who were holding out for peak prices are now rushing to list their homes, only to find that there are far fewer buyers than there were a year ago. This imbalance is putting immense downward pressure on prices across the region. The official numbers show a 3.3% drop in median home prices year over year. While that might seem less dramatic than San Diego's drop, it represents a complete reversal of the trend. Just a short time ago, Sacramento was seeing double-digit price increases. Now, it's in the red. The market has rapidly shifted from a red-hot seller's market to, at best, a balanced market, and in many neighborhoods, it's quickly becoming a buyer's market. Sellers are having to offer concessions, pay for closing costs, and accept offers below their asking price. Sacramento's story is a cautionary tale about what happens when a market's growth is fueled almost entirely by external migration, rather than organic, local economic strength. Once that external tap is turned off, the market is left exposed. The foundation wasn't as strong as it looked. For buyers, this means more choices, more time to make a decision, and more negotiating power. For sellers, especially those who bought in the last couple of years, it means facing the reality that they may have to sell for less than they paid. The capital's housing market is facing a major reality check. Of course, no discussion about a California housing correction would be complete without talking about San Francisco. This is the city that has long been the poster child for unaffordable real estate. The stories from here are legendary six-figure bidding wars over fixer-uppers, tech millionaires buying sight unseen, and the average person needing to be a multi-millionaire just to afford a modest home. For a long time, it seemed like San Francisco real estate operated in its own universe, immune to normal market forces. But the city by the bay is facing a multifaceted crisis that is hitting its housing market hard. The tech layoffs that are impacting San Jose are having an even more profound effect here, as many of those high-paying jobs were centered in the city itself. This, combined with a persistent doom loop narrative about crime, homelessness, and a declining quality of life, has led to a significant exodus of residents. The city's population is shrinking, and with it, the demand for housing. While the official year-over-year price drop is around 2.5%, that number is incredibly misleading and doesn't tell the whole story. When you look at the data from the absolute peak of the market in early 2022, San Francisco home prices are actually down by a staggering 15%. That is a collapse. A 15% drop on a median price that was well over $1.5 million is a catastrophic loss of equity for anyone who bought near the top. We're talking about losses of $200,000, $300,000, or even more. The pain is especially acute in the condo market. The downtown and south of market areas are filled with sleek, modern high-rises that were built for a generation of young tech workers. Now, many of these buildings have high vacancy rates. You can see it in the listings. Hundreds of identical-looking condos for sale, many of which have been sitting for months. Sellers are not only competing with each other, but also with the punishingly high HOA fees that can add thousands to a monthly payment, making them even less attractive to buyers in a high-interest rate environment. San Francisco is a market in a deep and prolonged correction. The affordability issue, which was always extreme, has been compounded by a crisis of confidence in the city's future. Buyers are hesitant, and sellers are getting desperate. Price cuts are the norm, not the exception. For the first time in a generation, buyers have real power in San Francisco. The question is no longer how high can prices go, but how low will they fall before they finally find a bottom. It's a dramatic fall from grace for what was once the most untouchable real estate market in the world. Now, let's talk about the big one. Los Angeles. The LA housing market is a beast of its own, a sprawling, diverse megalopolis with dozens of micro-markets, from the ultra-luxury of Beverly Hills to the more affordable suburbs of the valley. For years, it felt like the entire county was on fire, with prices soaring everywhere. But even this massive market is not immune to the forces of gravity, and we're starting to see the cracks appear, even if it's in a slow burn. Officially, the median home price in Los Angeles County has seen a relatively modest drop of about 1.2% year over year. On the surface, that might sound like nothing to worry about, just a slight cooling. But you have to remember the scale we're talking about. The median price in LA is still incredibly high, hovering around $900,000. So even a small percentage drop translates into a significant amount of money. A 1.2% drop on a $900,000 home is still a loss of over $10,000 in equity. More importantly, that county-wide average is hiding some much bigger drops happening in specific neighborhoods and price points. While the ultra-high-end luxury market might be holding up in some areas, the entry-level and mid-tier markets are feeling the squeeze much more intensely. These are the homes that regular working families try to buy, and they have been pushed to the absolute brink of affordability. With today's mortgage rates, the monthly payment on a median-priced home in LA is simply out of reach for the vast majority of residents. This affordability ceiling is the primary reason for the slowdown. There just aren't enough buyers who can make the numbers work anymore. This is causing inventory to creep up and homes to sit on the market for longer. The frenzy is gone. Instead of 20 offers on the first weekend, sellers are lucky to get 1 or 2 offers after a few weeks. And those offers are often coming in at or below the asking price, with buyers demanding contingencies for inspections and appraisals, things that were unheard of just a year or two ago. So while the headline number of a 1.2% drop might not sound like a crash, it's the start of a significant trend. It signifies that the upward momentum has been broken. For a market as massive and influential as Los Angeles, even a slow, grinding decline has huge implications. It means thousands of homeowners are losing equity every month. For potential buyers, it's a sign that patience might be rewarded. The LA market is like a massive ocean liner. It takes a long time to turn, but it appears to be turning now, and the direction is down. For a long time, the Central Valley, and Fresno in particular, was seen as the last bastion of affordability in California. It became a magnet for people fleeing the insane costs of the coastal cities. This wave of migration created its own boom, driving prices in Fresno up at a pace that was just honestly unsustainable. Now that wave is starting to retreat. Fresno's market is cooling significantly as the affordability issues that plague the rest of the state have finally spread inland. The core problem is simple. Prices in Fresno were pushed so high that it's no longer the bargain it was. When you combine those elevated prices with today's higher mortgage rates, the monthly payment for a typical home in Fresno has become a major stretch, even for people moving from more expensive areas. The financial advantage of moving to Fresno has been eroded, and that has caused demand to pull back sharply. As a result, home prices have started to dip. While the drop isn't as dramatic as in the Bay Area, it's a clear reversal of the previous trend. More importantly, inventory is rising. The number of homes for sale is climbing steadily as buyers hesitate, and sellers, who were hoping to cash in at the peak, are now putting their homes on the market. This is creating more competition among sellers, and giving the few remaining buyers more leverage. We're seeing an increase in price reductions, and homes sitting on the market for 30, 60, or even 90 days, which was unthinkable during the boom. The mindset has shifted from a desperate scramble to buy anything available to a more cautious, wait-and-see approach. Buyers are no longer willing to overpay, and they are taking their time to find the right property at the right price. This is a fundamental change in market dynamics for the Central Valley. Fresno's slowdown is a clear indicator that the housing correction in California is not just a coastal phenomenon, it's spreading. When even the affordable areas become unaffordable for the average person, it's a sign that the entire state market has reached a tipping point. The price relief is a welcome sign for local residents who were priced out, but it's a source of anxiety for those who bought in the last couple of years, who are now seeing their newfound equity begin to evaporate. Let's talk about Riverside, a key part of the Inland Empire. For years, Riverside was one of the primary destinations for Los Angeles escapees. It offered a classic value proposition. You could sell your small expensive home in LA, buy a much larger newer home in Riverside for less money, and commute. This dynamic made Riverside one of the hottest real estate markets in the entire country, with prices soaring as demand seemed endless. But that dynamic is now breaking down. The commute, which was always a major drawback, has become even more painful with record-high gas prices. The financial savings of living in Riverside are being eaten away at the pump. More importantly, the price gap between Los Angeles and Riverside has narrowed. Prices in Riverside rose so quickly that the drive until you qualify strategy doesn't work as well as it used to. The value just isn't there in the same way. As a result, demand is waning. The flood of buyers from LA has slowed down, and the local market is struggling to support the high price levels that were established during the boom. We're seeing prices slip as more and more homes hit the market and sit there. Sellers who bought just a year or two ago are finding that they have very little room to negotiate if they want to sell, and some may even be facing a loss. This is a classic example of a market that was heavily dependent on a specific migration trend. Now that the trend is weakening, the market is left exposed. Inventory is up, sales are down, and the feeling on the ground has shifted from optimism to anxiety. Sellers are adjusting their expectations, and buyers are finally finding that they have some breathing room to negotiate and be more selective. Riverside's slowdown shows how interconnected the Southern California housing market is. The cooling in Los Angeles is having a direct and immediate impact on the surrounding commuter markets. For anyone who owns a home in Riverside, it's a time to be cautious. For anyone who was priced out and dreamed of buying there, this could be the start of the opportunity they've been waiting for. The once unstoppable Inland Empire boom is clearly running out of steam. Across the bay from San Francisco, we have Oakland. For a long time, Oakland was the gritty, more affordable alternative for those who wanted to be in the Bay Area but couldn't stomach San Francisco's prices. As SF became more and more expensive, a wave of buyers and developers moved into Oakland, driving a renaissance in some neighborhoods and causing prices to skyrocket across the city. Oakland's market was on a tear, riding the coattails of the larger Bay Area tech boom. Now, Oakland is feeling the Bay Area chill in a big way. The same forces that are pulling San Francisco down are having a major impact here as well. The tech layoffs mean fewer high-income earners are looking to buy homes. The general sense of economic uncertainty is making everyone more cautious. The demand that once seemed insatiable has weakened considerably, and the Oakland market is feeling the pressure. We are seeing a significant drop in prices from the peak. While it might not be the 15% we've seen in San Francisco, it's a substantial decline that is causing a lot of concern for recent homebuyers. Sellers are having to fundamentally readjust their expectations after years of rapid growth. The strategy of listing a home for a low price to incite a bidding war is backfiring. Instead of getting offers over asking, sellers are getting lowball offers or no offers at all. The market has become saturated with inventory in certain price points, especially for condos and townhomes. These properties, which were once seen as a great entry point into the Bay Area market, are now sitting for months. Buyers are wary of crime rates, school quality, and the overall cost of living, and they are no longer willing to pay a premium just to be in the Bay Area. They are demanding value, and many are finding that Oakland's current prices don't reflect it. Oakland's downturn is a sign that the entire Bay Area ecosystem is recalibrating. It's no longer enough to just be cheaper than San Francisco. The market has to stand on its own fundamentals, and right now, those fundamentals are shaky. This is creating opportunities for patient buyers, but it's a very difficult environment for sellers who are trying to navigate a market that looks completely different from the one they bought into just a short time ago. The chill has definitely set in. Finally, let's head to the heart of Orange County and look at Santa Ana. As the county seat, Santa Ana is a dense, vibrant city that has historically been one of the more affordable entry points into the otherwise incredibly expensive OC market. Its central location and strong community have always made it a desirable place to live. But like everywhere else, it was caught up in the housing frenzy of the past few years, and prices were pushed to levels that are proving to be unsustainable. The slowdown in Santa Ana is now clearly visible. Home values are dipping as the potent combination of high prices and high mortgage rates has sidelined a huge portion of potential buyers. The first-time home buyers, who are the lifeblood of a market like Santa Ana, are finding it nearly impossible to qualify for a loan on a median-priced home. This has created a vacuum in demand at the lower end of the market, which is now rippling upwards. As demand has fallen, inventory has started to grow. Homes that would have been snapped up in days are now sitting on the market for weeks. This is giving buyers, the few that are left, a newfound sense of power. They are becoming more cautious and more selective. They are no longer waiving contingencies, and they are not afraid to submit offers below the asking price. The fear of missing out has completely disappeared from the market. Sellers, on the other hand, are starting to feel the pressure. Many are realizing that they missed the absolute peak and are now facing the prospect of accepting a lower price than their neighbor got 6 months ago. We are seeing a steady increase in the number of price reductions across the city as sellers try to chase the market down and attract a buyer. This is a classic sign of a market in correction. Santa Ana's experience demonstrates that no corner of Southern California is immune to this downturn. The affordability crisis reached a breaking point, and the market is now being forced to correct. For the many families who have been renting in Orange County, dreaming of one day owning a home, this slowdown could present the first real opportunity in years. But for those who recently bought in Santa Ana, it's a stressful time as they watch the value of their biggest asset begin to slide. So, there you have it, 10 major California cities where the once unthinkable is happening. Prices are falling. From the tech hubs of the Bay Area, to the sunny shores of San Diego and the sprawling suburbs of the Inland Empire, the correction is real, and in some places, it's brutal. The combination of unsustainable prices, high interest rates, and shifting economic fundamentals has finally broken the back of the California housing market's relentless climb. If you own in one of these cities, buckle up. It's about to get interesting, and you need to be paying very close attention to your local market. The big question on everyone's mind is whether this is the bottom or just the beginning of a much longer slide. Are these price drops a temporary blip or a fundamental repricing of California real estate? We want to know what you think. Drop your thoughts in the comments below. Are you seeing this in your neighborhood? Would you buy in any of these markets right now? Or are you waiting for prices to fall even further? Your insights from on the ground are incredibly valuable, so let's get a conversation going. This is a rapidly changing story, and we'll be tracking it every step of the way to keep you informed. Thank you so much for watching. Don't forget to like this video if you found it helpful, subscribe to Houseline USA, and hit that notification bell so you don't miss our next update. Your support helps us continue to bring you this critical information. Also, if you have any music timing suggestions from the YouTube Studio library, let us know in the comments. We read all of them. Thanks again, and we'll see you in the next video.